Well, good morning, everybody. It's wonderful to see so many people this early on a Saturday morning. This time I'm normally still in bed. The subject is neuroscience. It says of trading, but it's neuroscience and trading. So it's basically about the human mind, the human brain, and the emotions that go with it. Right. I'd like to start with this slide, actually. It's by Matt Ridley of The Times. He wrote an article on science in February. And his starting line was, "On the voyage of science, we are perpetually sighting great continents of ignorance that we did not even know existed." I mean, in a way, it says it all. This was my experience when I first came across technical analysis in the late 70s. After a major trauma in the London gilt edge market, which I was trading at the time. And I went off and bought a book on technical analysis. And it was a revelation. Why wasn't I taught this at university? Markets went down as well as up. That they had trends, they had rhythms, they had natural oscillations. And towards the end of this talk, I'm going to step us into a little bit of new territory, with your permission. But how to put this? Yeah, well, okay, let's just get on with it. So little known facts, things that are useful for us to know. One of the first things is that the brain and body co-evolved, through thousands of years millions of years of history. So the brain is large, our brain is large, because the body itself is complex. And of course, conversely, that the body is large because the brain is complex as well. So we can, do things with our fingers and thumbs because our brain is large. Now, the whole idea of mind involves both the brain and the body. And this is the bit that's been missing from economic theory, for example, for years. The brain is only one part of our information processing system that we have within us. And the other thing which is related to this is that the body, its priority is survival. It's going to start at that level. So anything that triggers off that system is going to affect the way we think. And the really important thing here is that the body can't really distinguish between real and imagined threats. Another little known fact, learning itself occurs in 3 phases. There's new information is presented to us, we have to absorb that information, and then we apply it. And the absorption phase uses energy. It actually absorbs energy from within the system so that it can make the transfer from long to short-term memory. This is one of the insights of Donald Hebb years and years ago. And while this is happening, energy is diverted from other activities. So while we're absorbing information, there's something that we can't do or can't do as effectively as we were doing it before. So there's a sort of a rest phase, if you like, but there's a lot of internal work going on. So this is not the S-shaped learning curve that we've all got very used to seeing. The S-shaped learning curve looks basically like that, and we all know it. We start slowly, there's rapid progress, and then there's some sort of ceiling. It's the sense of how information is integrated into the system, but it's not actually the process of learning. Mills, in the 60s, I think it was, doing some research, found that actually it looked differently. There's a fast start, there's a relapse while learning is transferred from short-term memory to long-term memory, and then there's the actual application of the learning until at some stage the system had become exhausted. So learning, according to Henry Mills, is a 3-stage process, and my experience in the market is exactly that. Now, Daniel Kahneman's prospect theory, another little known fact, in the general sense of that term. It was introduced yesterday and presented very, very effectively, but I think it's worthwhile emphasizing because it's exactly the sort of thing that we as technical analysts and market traders and investors actually need to know about. There are three elements to prospect theory. One is what's called the endowment effect, where owning something increases its value to you. Now, this is all based on really, really good research. So this is not just Tony Plummer thinking up some ideas. This is really good backed up research. If you own something, like a house, its value to you is increased. The second thing, which was emphasized yesterday, is loss aversion. Losses have a greater psychological impact than gains. When you think about it, it's obvious, but it has really dramatic effects on the way we run our portfolios. And the third one is a reference point, that there's always an earlier valuation that you effectively use when you're judging profits, losses, when to sell, when to buy, that sort of thing. There's a subjective earlier state. And the net result is that no matter how often we're told not to do it, traders actually do cut their profits early and run losses. And this was a point that was really significantly made yesterday. So what's going on? Well, prospect theory identifies very real subjective biases which contradict rational left brain, if you like, left brain behavior. And that's been a problem between prospect theory and economic theory. The sense of self in prospect theory, in any other come to that, sense of self comes not just from the body. What we think about ourselves is not just the body. It includes what psychologists and psychotherapists call internal objects, which signify our attachments. So our assets, our things we've just bought, actually become, in a psychological sense, part of us. And so when we are faced with a need to protect that self, which includes all these assets and owned things, it really does create a sense of anxiety, which we then have to deal with. Financial losses, quite obviously in this sense, affect not just the bottom line, but also our sense of self. So it's not just actual losses, it's also potential losses. What might happen in the future? You know, we have this ability to project into the future. So market losses themselves, this is an important point. The possibility, just the possibility of an increased loss once the market's going down outweighs whatever the rational possibility of probability of a loss might be. Okay, so the possibility outweighs the probability of an increased loss. And eventually we just have to reduce that possibility or probability to zero. We've just got to get rid of the assets that's causing us the problem, which of course is why we sell at I sell at the bottom of the market. And there's no comparable mechanism for profits, which is why rollover takes so long at the top. Just to indicate this, this is the Dow during the 2007-09 market, and on the bottom line there is the volume index. As it goes into the high, there's a steady but relatively minor increase in volumes. Then you get the first sell-off, and there's a spike in volumes. And as the bear develops, volume goes up, and it peaks. So as the market goes down, volume goes up. It's not the highest of the high, but volume stays high as the market then forms its low. So the volume rise as the bear evolves, which kind of is consistent with what prospect theory is saying. So fear and anxieties, I've said, imagined threats are the same as actual threats, okay, as far as the body is concerned. So whatever we've got going on in our mind is going to have an effect. The brain simply can't tell the difference. So fear and anxiety have a physical dimension. So we're getting into the idea that the body's important in the decisions we make, and the fear and the anxiety, which are so effective in motivating us, actually have a definite physical dimension. and psychologists and psychotherapists call this flight, fight, or freeze. Actually, I've got flight and freeze, but flight, fright, and freeze. And the bit of the brain here is called the amygdala. It's only relatively recently found, actually, that there are two little bits to this, so we should be talking about the amygdalae, but I'm just going to refer to it as the amygdala. And this overrides rational thought. So we need to understand the role of this particular piece of our brain. The whole brain itself, this is an oversimplistic way of presenting it, but it's effective for what I want to explain to you now. It has three parts. There's the brainstem, which comes from our reptilian ancestry. There's the limbic system, which is the emotional part, which comes from mammalian ancestry. And then the neocortex, which makes us distinctively human. So it's a three-part brain. And Paul MacLean called this a triune brain. And it's a good way of looking at it. So the brainstem is this little bit at the back. And it's involved in instinctive behavior, biological drives, compulsive behavior. So just imagine what happens when that's triggered off in our trading and dealing. The next bit is the limbic system, which is this circular yellow bit, and it deals with our emotions, our long-term memory. So this is where things that we've learnt that are fundamental are actually stored, and group behavior. And then, of course, there's a final bit, the neocortex, the human bit, which gives us our consciousness. The frontal cortex, which is a slightly smaller part of it, which affects our attention, our motivations, the monitoring of goals, all the things that we associate with what we do. And then within that, there's an even smaller bit, which is the bit that can regulate our emotions, and does. It deals with our abstract thinking, our recreation of the past, and anticipation of the future. So if we suppress this bit of the neocortex, the frontal bit, what we're left with is the other two bits, which is the brainstem and the limbic system. And so often this is what happens if we're not very careful about what it is we're doing. So the amygdala is this little walnut-shaped bit embedded in the lower middle of the brain, and it deals with change. So it stores memories of past traumatic events or something that's had a big emotional impact of it. I mean, many of you will easily remember the bad things that have happened in life. It then matches patterns. What's happening now is that the same as what's happened in the past. And if it does, it triggers learnt reactions. So whatever it is you've done in the past, you automatically then do it again. So if you get a surprise, you get what initially happens is an electrical spike in the brain, which runs from the back, what's called the occipital lobe, to the pons, which is just behind the ears. It activates the visual system, so you can immediately, I mean, it's very, very basic, so you can see what it is that's happening, so your attention then gets focused. And this is called the orientation response. But once your attention is focused, you can kind of see what might be missed out, on the periphery and other information. You're just focused on one thing. So if the amygdala is triggered, your body then becomes ready for fight or flight or freeze. And only after that does some degree of conscious awareness come back in. And what is in fact happening is your rational thought is short-circuited. So this is thinking slow and acting fast. You have to act before you, if there's a car coming to hit you, you need to move quickly before you even think about it. So we get a stimulus. There's then the orientation response, which is, as I say, the occipital lobe and the pons. Then that has to be interpreted. So there's kind of a rough and ready way of what this is all about, which is done by a bit of the brain called the thalamus. And just in case there's any danger, it shoots that information off to the amygdala, but that might not be all that's involved, so it then sends the same information in a longer route in case we need to anticipate the outcome to our reasoning faculty, which of course is in the neocortex. The interesting thing here is that it hits the amygdala so fast you don't even know it. 30 milliseconds apparently. Heaven only knows how they work these sort of things out. Where it's 500 milliseconds to go around the longer route. So you can see how the amygdala can be triggered much more quickly. From the neocortex, while it's up there, you'll start feeding in memories. The hippocampus, and you remember the taxi driver example from yesterday, they've all got big hippocampuses because of the not learning the knowledge, and that's then sent back to the amygdala. Now, if it's not activated, if we got the stimulus or surprise, but it didn't really mean anything to us, then we do nothing, status quo situation. But if it is activated, there's this physical fear response, which involves the brainstem, this little bit at the back, the biological responses, and a bit of the brain called the hypothalamus. So I'll just take a look at this in a bit more detail. The brainstem, which is part of the nervous system, basically. The bit here that's relevant is what's called the sympathetic nervous system, which is involved in this fight, flight, or freeze piece. And what happens if this is involved is things like the pupils dilate, the respiration increases, heart rate rises, digestion slows down, is inhibited, saliva is inhibited. So there's a definite physical effect here. And on the other side, while that's going on the other side, the endocrine system starts releasing hormones, which actually lock all of this into your body. Things like adrenaline to prepare you for action, testosterone for aggression, if you need to fight. Cortisol is one of the others, which minimizes the use of unnecessary energy. Endorphins to reduce pain, and oxytocin if you're involved in group behavior because it promotes attachment. So there's a lot going on in response to what could be just a very simple trigger. And the point I again want to make is that this means that your body is involved in your decision making. So fight, flight, or freeze. There's a sharp price fall, okay? We get an orientation response. Does this mean for us bigger losses? And please take on board here that I'm actually oversimplifying the situation just to make the points. Orientation response, does this mean bigger losses for me? There's a yes or no binary answer. No, okay, doesn't matter, I'm short anyway, so status quo. If yes, then this sympathetic nervous system is mobilized. Now, are we in a position to react? Are we lying out on a beach somewhere because we've made so much money it doesn't matter? Or are there other things going on where we can't do anything? If we can react, are we ready? Have we got our trade plan operating? And again, a binary response, yes or no. If it's yes, we can do something about it. And if you've been doing your trade plans properly and you're involved in the ebb and flow of daily trading, then you're going to use your objective buy-sell rules, and then the parasympathetic nervous system comes in and calms it all down. On the other hand, if you haven't done your trade plan and something's happened and you feel the urgent need to respond to it, which is part of the flight reaction, you get the parasympathetic nervous system certainly then operates. You think, oh gosh, right, I'm glad I've done that. But what you're really doing is just doing what everybody else is doing, following the crowd. There is another alternative, going back to can we react? We're not lying on a beach, we're actually at the trading desk, but something is stopping us from doing anything at all. It's the freeze response. And what happens is you're just going to go round and round and round this loop. And what happens here is that eventually cortisol gets put into your body because you're under extreme stress. And what the body is trying to do is to deal with the problem and make sure that it's not diverted from doing other things. So the orientation response has given you the focused attention. You know, you're focused on your screen or on the problem. Your sympathetic nervous system is mobilized, so you actually are in a state of fear, a heightened state of fear. It varies with people, but it's still there. There's anxiety there. And the combination of these two actually is a sort of a trance-like state. You know, you can't think of anything else, and your brain is not dealing with other things in life. So if we take this extreme example, so we are frozen, we've resisted for whatever reason taking losses, and that means the impact of every price change is going to be magnified on you. It goes on and on and on. Cortisol is being released into your system, and it's preparing your body for survival. It can't be avoided. That's what the body does. You're in a trance-like state, so you're open to suggestion. What are you going to do? You eventually sell. And this is, let's call a spade. This is the loser effect. You know, if we let ourselves get into this, then we are going to be selling at the bottom. So we're in survival mode in the loser effect, and we've got interruptions to our digestion, to our sleep, our immune system's not working properly, our sexual drive is down to nil. You're under prolonged and severe stress, so your blood pressure goes up, your cholesterol levels go up, glucose, and of course your body starts to react as it does when it's filled with all these things. You increase weight, there's a threat of a heart attack, and of course diabetes. And over my years in the city, these are the sort of things I have actually seen happen to people. And there is a widespread impact in the bear market. Long-only funds can't avoid the bear, so they've just got to sit and watch it and suffer the consequences. And governments literally can't stop it, even though they pretend they can. They cannot. And John Coates, and this is a really good book for those of interest, so I'll make a reference to it right at the end. John Coates argues that cortisol dominates the bear. So all these people in a long bear market, such as sort of 2008, 2009, there's a lot of cortisol going around the whole of the system. What about a bull trend? I'm really going to simplify this one. So prices rise, get the orientation response. Do I have cash to invest? Yes or no? And if it's no, we're long and right, so that's great, isn't it? Cash to invest? Yes, I have. So the sympathetic nervous system get mobilized, you get ready to do something. Can I react? If the answer's no, then let's just leave it at not doing anything. If you can react, of course you buy. But you could be following the crowd. This is the thing behind long bull markets. Round you go to the orientation response, prices go up again, and you're locked into this circle. And what happens is you get a lot of testosterone pushed into the body, particularly men. And what's going on here? What's this buy reaction? What's going on? John Coates actually is very specific about it, that it's individual, it's exuberance. He calls it exuberance. First of all, there are learnt beliefs about the trend. So you have to believe that the market's going up. It doesn't in itself take you by surprise. And my finding here is that this starts to happen after a 38.2% retracement of the bear. Once you go beyond that, then these learnt beliefs about the trend start to lock in because something is happening to fundamentals. And as far as this is concerned, it's probably one of the single most important pieces of information that a long-term fund manager can have. Testosterones get pumped into your body. It's slow-acting. It improves. Oh dear, there's a double entendre there. It wasn't intended. It improves your trading performance. And there's a feedback loop with prices. So as prices go up, the more testosterone is pushed into the body, and it's happening on a wide scale. John Coates used the example in the trading room where this is going on intensively and extensively. And then dopamine will get pushed into the body as well, because you need to know that you're feeling good about what's happening. So dopamine gets pushed in, and it's the pleasure at getting it right, and then there's the anticipation of the next trade, which is going to give you the bit more extra profit, and therefore the bit more extra pressure. And this is what John calls the winner effect, and it's very, very clear. So the winner effect, okay, testosterone, you need it for competition. It happens in the wild, and it happens in the trading room. And it's 10 times, give or take, I suppose, more in men than in women. So women are less prone to the winner effect. And I agree with Larry's comment yesterday that if we look forward 20 years, or maybe even 10, there are going to be more women in rooms like this and in dealing rooms, because they help. They help the system not to get out of hand. Your risk appetite is increased, so your attention is stabilized, you're focused on the rising market, your speed is fast, you react quickly, so there's this feedback loop with success. And you can see how it happens towards the top of the market. Everybody's doing the same thing. There's a lot of hormones, a lot of testosterone. The winner effect is very widespread. So John Coates says testosterone dominates the bull. So there's testosterone in the bull and cortisol in the bear. Of course, it kind of simplifies it, but you can see how what we're talking about here is the body being involved in markets. So this leaves me with 2 lines of inquiry, or left me with 2 lines of inquiry on as far as we as technical analysis are concerned. On the one hand, can we avoid this as individuals? Can we sort of be really calm and cool while all this is happening around us? And the other bit is, how is all of what I've just said related to collective experience? Is it just a group of individuals all doing the same sort of thing, or is there something else involved? And this has been one of my main line of inquiries over the last 20 years. So the first thing, I don't want to step on Alex's toes, because he's going to take you through the way he does things, but I just need to actually just deal with this particular one, neutralizing prospect theory. Now, the endowment effect, if you remember, is owning something will increase its value to you. So the thing that needs to be embedded in your mind is that whatever it is you've got is for buying and selling. Each of you will have a different way of dealing with that, but that's the ultimate objective. It's a trade. It's there to get rid of when you need to. Loss aversion, the critical one, the difficult one. Losses have a greater weighting than gains. So you always have to use a fixed exit criteria. The criteria or criterion can vary through time, but you need to be aware of what it is so that you're not just something happens and then you respond to it. It could be a stop loss, it could be a target, whatever it is, but it needs to make sure that it's a fixed exit criteria. Your reference point, an earlier state to evaluate gains and losses. My suggestion in this case was to just keep a written record of what you consider to be your valuation, so it's down there fixed in blue and white, black and white ink, whatever, so you know what it is, and it's not just a subjective thing that shifts from day to day. And the point here is that once you've defined the problem, prospect theory, you can kind of work your way to what the solution is. It'll be different for different people, but you define the problem, you've got a solution. And the other thing I'd add into this is that when your body is involved in making decisions, you need to be aware of what's going on. So one of the things I do with myself, and I've said to other people, is before you change anything, before you change your system, in fact, in many ways, before you deal, if you're a longer-term trader, you wait. You just wait to make sure that you're not responding to something specific that's going on in your body. I have to put here that hope and despair trigger different reactions. You make a decision today on, when you're really feeling good about anything, and you regret it tomorrow because you didn't take everything into account, so wait. The other thing is stress and exuberance, the despair and the enthusiasm, is actually information. And if you can just remove yourself slightly from it, you can tell that something's happening. In other words, the physical relevant, which is really what I'm trying to stress, is relevant to everything that you do. And finally, on this aspect, is don't ignore intuition. It's easy to forget that actually this is a valid way of making decisions. Doesn't mean you have to do something straight away, but if you're I'm not talking about stress and exuberance now, but this sense of I know what I need to do. Just wait, and if it's still right after a while, then you can do it. But intuition is important because your body actually knows more than you think it knows. Okay. Now, the next stage is how does this actually relate to groups? Us all doing things together. The starting point in the way I look at this is we as individuals, when we sit down at our trading desk, don't know everything. We simply don't. And being certain about anything is not actually the same thing as having all the information. And what happens actually is that we rely on others to give us that information. This is the way animals do it in the wild, and we've still got this same basic approach. And when this information comes in whatever form it comes in, and it's usually by seeing other people behaving in a particular way, whatever you thought, it gets overridden. This new information will take precedence. So the third bit of this is that we are therefore continuously looking at what other people are doing. Sometimes it's direct rational observation, the guy next to you in the dealing room or whatever it might be. But there's also a wider sort of non-rational sensing that goes on of the feeling about the mood of the market, the mood of the economy, what people are doing in the shops, what the taxi driver says, all of that sort of stuff. And what I'm talking about here is herding or swarming. Herding is a psychological part of the world. And the important bit here is that our brain is actually wired up to do this. It's not something that we fall into unnecessarily. It's actually wired for cooperation, social cooperation, cohesion. And what's involved is the right brain, which is to do with emotions, big pictures, and feelings. Okay, so again, our feelings are brought into all of this. And it does it in two ways. The first is an obvious one, which is imitation. We are trained from birth to imitate. There's a piece on mirror neurons. It was first came out about 15, maybe 20 years ago, and there's some debate about how influential these actually are. But the point is that the neonate, the little baby, has got to learn how it feels, and it does it in relation to its, usually to its mother or whoever the important other is. And so what ends up happening is that bits of the baby's brain light up, as do the mother's, and it's why they mirror each other. So they're getting so the baby then gets to learn its feelings, and this stays with us. So we look at somebody else's face, and we can know we can basically feel ourselves what it is that they're feeling. So other facial expressions, posture, tone, voice and movement, all this is taken into account. And the other bit is emotional contagion. It's this bit about information flows, because the information is passed on with feelings. You don't just take a piece of data and say, this is what it is. There's some way in which it's passed on with this is bearish, this is bullish, this is whatever. And the hormones, the steroid hormones that I mentioned earlier on, once they're all triggered, it makes sure that over a relatively short period of time, we all have basically the same sort of feelings, the same intensity, so we're all pointing in the same direction. And we have very little choice about it. So if we haven't been able to remove ourselves by doing our technical analysis, trade plans and all, then we get involved in this. And these are non-rational groups. And specifically make the point about it being non-rational, felt sense, feeling orientated, rather than irrational. Once you start talking about irrational, you get the idea that this is all wrong, inappropriate, nobody's thinking, which is partly true, but it's non-rational because it's the feelings and bodies are involved. And there's a big body of theory out there if you care to look at it. Behind this, there are 5 principles behind group behavior. One is that a group, small, big, huge, whatever, is self-organizing, so it's got a purpose, there's a reason it's come into being, and it persists through time. It doesn't just come today and it's gone tomorrow. It's what's called a superorganism. The parts are expendable. Okay, so nobody needs to, the market doesn't need to know that you're bullish or bearish. You're just a bit of the system as far as the crowd is concerned. Shared beliefs, they act as glue. Everybody in a bull market or a bear market is basically beginning to think the same way. It holds people together. It acts as glue. And the belief, whatever it might be, is accepted uncritically. There's not a lot, as time goes on, the herd, the group, tend not to think too much about whether or not they're right or wrong. They're just doing it. And these beliefs are contagious. It's extraordinary how it's like a virus, straight out. It's a neural network. A group is a neural network. There is a sense of a group mind. Of course, we can't see it, we can't analyze it, we can't put it through a scan, but it exists. And each of us as individuals are nodes or neurons or whatever you want to call it within that group mind. And there's been a lot of work done on this sort of thing. And the final bit, which is really getting us to market, intergroup competition. There's a pecking order. Once a group is formed, it needs to be more important than whatever the other opposing group is. It's there for competitive purposes, for competition. So obviously there's a group mentality, group psychology involved with warfare. And it's an us versus them situation. It is psychological, and group psychology controls nation states, armies, religious sects, political parties, football crowds, gangs, and stock markets. Okay, bulls versus bears. And the really important thing is that we as technical analysts need to stay out of that. We need to observe it rather than be part of it. Groups always follow a leader. There's always something that represents the crowd beliefs, the group beliefs. And in our case, it's price movements, price trends. They are a direct reflection of the group beliefs about where the stock market's going. So what I'm now going to go into is the way the market behaves and the way, and it's very simplistic, but it's the way that it gets reflected in a stylistic chart, if you like. So we start off, end of the main thrust of a bear. Everybody's sold out. You get a bear squeeze. Market jumps. And there's a partial renewal of that bear sentiment, and there's a retest of the low, or it goes down to a new low. But what's happening here, that the bearish crowd mentality is basically dissolving as that takes place. Then there's the anticipation of the bull. The market starts to rally again. And there's this, once it goes through this 38.2% level of the previous bear, then you get the unchallenged bull. This is where it really starts. This is where the crowd starts to pull its energy into itself until you reach the top. So the first stage is learning. There is a bit of a transition phase, and this is all stylized, of course, and then you go into the learnt bull phase. So a genuine bull is a learnt behavior pattern. At the other side, going to bear, you get the profit taking. You get a partial renewal of the bullish sentiment, retest of the high, maybe even a new high. That's where the crowd mentality begins to dissolve. 38.2% of the bull goes through that. We've anticipated the bear rather. Go through the signal level. Wow, we're into an unchallenged bear until we reach the low. So there's learning at the top, bit of a transition period, and then the learnt behavior. Learning, just to repeat one of my first points is learning occurs in three waves, up and down. See, now I can pull all this together into, we're thinking about a mass mind now, so each of us are neurons or nodes in this mass mind going on, all experience our own thing, but as a whole, what's going to be experienced is, from the bear, we get the orientation response, markets jump, okay, the whole of the market's now on high alert, there's a pullback, rest and digest phase. When the market starts to pull up again, then the group amygdala are activated. We go through the point, testosterone gets pushed into the system, and off we go, a winner effect. Okay, I can reverse this now. Orientation response as the market drops off the top, bit of rest and digest. The amygdala is activated. We go through the cell level, and cortisol is pumped in. And that's the loser effect, okay? So it kind of makes sense. This is very simplistic, but it kind of makes sense. The actual pattern varies depending on the bigger cycle. Now, I've done a lot of research over the years, and what I found, I can't even remember now, it's so long ago, is that this particular pattern does exist. It actually exists in the market, but it doesn't exist on its own. It exists with two other similar ones, and they are distorted by what's going on at the higher level. So there are three of these. Okay, the first one pulls us away from the old world. The new one introduces what lays down the new system, and the last one is really quite difficult. It's to do with getting rid of what we don't need anymore. Natural selection, those that can't survive. And I call these the transition, the innovation, and the consolidation cycles. Now, Ralph Nelson Elliott and William Gann treated these sequences differently. They're both there. I'm going to simplify again a bit, but you can see how they come out. With the Elliott interpretation, base of the market, trend, and then the correction phase, run a straight line through these with a correction summer at the end. It's going to vary depending on how you put these lines in, but basically you get 1, 2, 3, 4, 5, 1, 2, 3, 4, 5 with the correction, three-wave corrections right the way through. So I mean, so the Elliott 5-3 formulation shows that some form of evolution is taking place. Now Gann came at it slightly differently, in effect. So in a sense, what those are absolute cycles, and these are rates of change. The first cycle takes this shape. The market starts off in the base, and then there's a sharp pullback, which is what makes people double think about what they're doing. It's basically an energy cap in the first cycle. Then you get the trend, which has got a lot of momentum in it. Goes up and down, but there's momentum in it. And then the final bit is there's an energy gap in the whole process, which actually ends those three cycles. Each cycle has an evolution-specific pattern. Now I can overlay the Dow on this, and these sort of patterns are quite extraordinary. So we've got the base, the trend, and the correction. This is an average of three 35-year cycles. These are the dates. The first one starts in June 1910 and ends in April 41. The last one is September 81 to October 2012. It's an average, but look how closely it actually follows that dotted line. So from left to right, it's 32 years, but when you lay the template on this template on what's happening in the market, there's always a gap, a lag before it comes into effect. So the dates have to be, the whole thing, we're going to start, if it starts from the end of one, it starts with this gap. And you can see that October 2012 is where the last one finished, 35 years. And it picks out the big corrections. 1916, 1953, 1987 equity crash. And at the end there, the big ones, 37, 38, 73, 74, 2008, 2009. How extraordinary, that this pattern picks out those major events in the market. So we can make a little forecast at this stage. The new sequence is going to start I think it's only 2016, but the mathematics suggests it could be a little bit earlier than that. And this process is then going to start off, and we're going to reach the end of that first cycle in 2025-27. I'm running a bit short of time, but just hold on to that date, 25, 20, 27. And if there's going to be a crash, it's going to be 2021, 2023. I think 2022 is the central point. But that's what this says. The pressure behind change. This is the new stuff, all right? In William Gann's Tunnel Through the Air, he hid a pattern. And he did it by comparing the chapter number with the number of pages. And that's the pattern that comes out of it. There's a book that I have out which contains all this, so I'm not going to put it in a lot of detail. In fact, I'm going to go through this quite quickly. It's laid in a square. It's got three waves, 1, 2, 3, A, B, C, and each wave itself goes in 3 sections. It's split into 2, so that the low is at the 50% mark. So you get a 1, 2, 3 on the left, 1, 2, 3 on the right. You get a shock. This is the learning coming in, a shock. It gets absorbed. Then you get your applied learning until there's, the system is exhausted. And then you get this energy gap. This is the bit that is missed by politicians and policymakers in particular. And then the market or the economy, whatever it is, moves to a new structure. And again, it's 1, 2, 3. This is an amazing, amazing piece of work. And it represents a life cycle of a living system, and you can actually put your own year, if you convert it to percentages, you can put your own age on it and see where you are, because it's got the midlife crisis. It's a real thing, it actually happens. And I believe that this is Gann's missing mass pressure pattern, and it kind of pulls together all the stuff that he was talking about over the years, and was a bit shy, let's put it like that, about releasing to the world. Does it work? Absolutely it does. It is just so extraordinary. So this is an average of 4 cycles of wholesale prices, 1792 to 2002. This is the 54-year Kondratiev price cycle, and I've overlaid the blue line on his pattern. I'd just like to hold it there for a moment so you can see it. It's, the way it's happened is you couldn't tell the difference between the two until maybe at the end, but the turning points are the same, even though the extents aren't. So these are the dates. Starts 1792 to 1840. The last one's 2000, starts in 2009. It's all, on the right-hand side, look up from 2057 to 2002. That's when the cycle last ended. So the 2000 to 2002 cycle, bear market, was actually a Kondratiev event. This lasts 47 years. There is a 7-year gap as we run into it, and I think this switches the system on. Actually, this gap. So 2002 it started. 2009 the new pattern came into effect. And it will eventually take us to a high, and the high is rapidly rising money supply, which we've got or getting, and historically it's been a war. Napoleonic War, American Civil War, First World War, Vietnam War. I don't know what's going to happen in the future, but it's pretty irresistible. We're here. How do I know we're here? Well, the red line is the pattern that we've had since 2009. We're in a slightly inflationary phase, but within the context of a disinflation. So what's happening in Europe at the moment has a future. There is disinflation taking place. Then we're going to go up into a big inflation, and 2024, 2027, there we are. That's the date I used previously. And just to lock this whole thing in place, when the energy gap takes place and we go down into a low inflation era, history picks them out. Era of good feelings, Gilded Age, Roaring Twenties, Reagan Revolution. It locks it in place. Now, I've run out of time. I did have a bit more to say, but I'm going to leave it there. If anybody specifically wants to take it up, I can show them some of what I've got. But the main thing is, we as traders are affected by our bodies, by what happens when we're under stress. We need to avoid that stress, if at all possible, follow a trade plan, and then if all this feeds through into group crowd emotions, which has this direct effect. So if you look at this sort of thing, you know where you are in the big picture, and you can build your trading plan around these sort of things. Look at that.
Thank you, Tony. As usual, I've always listened to your presentation sort of in shock, in both a good and a bad way. I remember Tony talking in Brisbane in 2010, and I watch the TV now and I still think of things he said back in 2010 about what was going to be happening in this decade. But quickly, while he was talking, I thought of a couple of quotes from Charles Glassman, who wrote The Brain Drain, which I thought were relevant. One is, before you can be an expert on anything, I must first become an expert on me. And the other one is, it's how we nurture the good and deal with the bad that ultimately shapes our destiny. And I think both those quotes apply to the markets. So thank you very much, Tony.
Oh, thank you very much. Thank you.